Well, yesterday we talked about using a name of a company to kind of inform our investment perception of that company, right? So this is a mental shortcut where you're using, information that's largely irrelevant when it comes to, valuing a company, what its fundamentals might be like. I want to think about what we can do to counteract that. And the biggest thing you can do is have a concrete investment thesis for any name that you're buying, whether it's debt or equity or whatever it might be, that there's a concrete reason with solid fundamental data to back that up. All right, so let's think about the efficient market hypothesis. I think everyone's familiar with that, right? We're saying, that in the weak form, all historical prices are already incorporated into the current prices. In the semi-strong form, which seems to be kind of the consensus where, things probably are, that all public information is currently built into the stock price. Of course, there's a strong form that says that everything, public, private, all this information is already perfectly built into the market. I would argue that we're somewhere, in that all public information, but that there are definitely times when, for whatever reason, a stock deviates from kind of the intrinsic value associated with this all public information standpoint. Now, in general, we have to think that when we think about a stock price, what we're saying is, the current price is kind of the current market consensus. That's where the market thinks it is, right? And that, again, information is largely known, especially in the public space. Now, that's kind of where I think we are from an efficiency standpoint, and an information incorporation standpoint. Now, if you're an active manager, then you need to have some kind of reasoning that says that there's a reason why I can pick stocks and outperform the market, right? So I think there's two places you can think about that, right? Is number one is the market has either underreacted or overreacted to this information that we talked about in terms of market efficiency, right? So the information's there, but the market is not interpreting that correctly or overreacting. There's hype, or there's something is out of favor, and that's causing kind of this pricing disconnect. Now the other thing is the market could just be wrong, right? So there's information out there and we know what it is, but we're just saying, hey, given that information, this is going to happen, and that's just plain and simply wrong. So let's think about that. So I want to think about an example of an under or overreaction. Now, if you think back to 2009, Avatar came out with a gigantic hit, and it was in 3D. So I remember distinctly having conversations in the office about what this meant for industries associated with entertainment and what 3D was going to do from there on out. So one of the people was saying, look, 3D technology is, people love it. It's going to take over. Everything is going to be in 3D right now. We have TVs and devices that make it easy for everyone to have a 3D experience. We can do it in our homes. We can do it with a laptop. We can do it with our iPad, whatever, that it's there and it's there to stay. Where other people, myself included, were saying, look, every 20 years, there's some 3D success story, and every 20 years, people say, look, it's taking over, and we will never go back to 2D entertainment. But in either case, we say, like, well, is the market overreacting or underreacting to the news that, in this very instance, there was a huge success story with 3D, right? Okay, so I would argue that, these two people, here, one saying that the market's underreacted to the new 3D technology, and the other person say that the market has actually overreacted to 3D technology. I think we know how that played out, but that's just an example of like how you can play that type of information in terms of how, like, why the market is wrong, why the consensus is wrong. Now, the other thing is we say, look, hey, the market's just wrong. They don't understand this company. So for an investment thesis, and this is just an example, I think we can think about Lyft and Uber. I think the consensus is that Lyft and Uber, they are in general alternatives to taxi services. And you might say, well, they have a platform that facilitates it. Therefore, it's attractive in that regard. But in general, it's just a taxi alternative. And you might have a valuation associated with that story. Now, your investment thesis could be, no. It's not just a taxi. It's going to take over spaces like U-Haul and things of that nature, where it's more than a taxi company, and therefore a higher valuation is justified. And when this actually fully plays out, I will be rewarded with extra return because the market was only anticipating kind of that one component of their business model. Market's wrong. I guess differently, and I'm correct going forward. So again, I think what you want to do is you want to avoid these mental shortcuts where you're just using something like a name to inform your investment decisions. Even when that's subconscious, you need to think about that. And what you really want to do is identify a true mechanism for return deviations from kind of the market norm or the market average. If you do this, I think you're going to be better off, and you'll help kind of lower the chances that you're falling into some sort of behavioral trap. Thank you so much for listening, and we will talk soon.